Hello everyone, I'm David Darst here to review the first quarter of 2022 with you. It was a head-spinning quarter. There were big moves up, big moves down during the quarter. The S&P 500 closed at 4530, down about 4.9% year to date. The NASDAQ, which is very technology heavy, as you know, it suffered an even larger decline of 9.1% over the quarter. These major indexes, this is the first down quarter after 7 up quarters, and it happens to be the first quarter in the past 2 years. And as you know, the Russia-Ukraine conflict, it rattled already stretched supply chains. So this added inflationary pressures and inflationary worries. As you know, the Fed has begun a policy of interest rate tightening. On February 21st, Fed Chair Jay Powell, in a speech to the National Association of Business Economics, announced his inclination, if necessary, to quell inflation, to raise interest rates rather than 25 basis points, which is what the market had been previously, financial markets had been anticipating a 25 basis point increase at the May 3rd, 4th Federal Open Market Committee meeting. He said, look, I'm prepared to do 50 at that meeting, at the June 14th, 15th meeting, or whatever it takes to bring down inflationary expectations. The 2-year Treasury closed the quarter at 2.28% yield. It started at 0.78 back on January the 1st. So that's a 150 basis point increase. The 10-year closed at 2.32% yield. And that is a 169 basis point increase versus the 1.63% yield at the beginning of the year. So the difference between, and we've talked about this in previous visits with you, the difference between the 10-year and the 2-year, which 1 year ago was 160 basis points. At the beginning of the year, it was 79 basis points, and now it's a minuscule 4 basis points. And as you may know, or as you may have heard, at the very end of the quarter, a couple of times during the day, it actually slipped into negative territory. That means the 2-year was actually above the 10-year. West Texas Intermediate oil prices were up 33.3% for the quarter to $100.28 per barrel. And the Brent marker of, which is an international marker of crude, $107.91. The best quarter in history for the S&P energy subsector, the energy sector, up 38% for the quarter. Wheat was up 31%. Corn was up 26%. That's the best quarter for wheat since 2010. And of course, both Russia and Ukraine are major exporters of wheat. Ukraine, major exporter of corn. You had stock splits announced by Tesla. They didn't say yet how they're gonna break it down, but you had Amazon announce a 20-for-1 stock split, and of course, Google Alphabet, a 20-for-1 stock split. And the Google Alphabet will start trading the new price sometime around July the 4th. What are the concerns on investors' minds right now? Look, these are the consumer confidence, all right? Consumer confidence and consumer sentiment. Consumer confidence relates to spending and employment, which are very, very strong. The jobs market, we'll come back to this in a moment. The jobs market for January was 467,000 jobs increase, unemployment rate 4%. For February, it was 678,000 jobs increase, unemployment fell to 3.8%, and the March number, which just came out, 431,000 increase, and unemployment fell to 3.6%. So people are asking me what could derail this economic recovery. The labor market continues quite strong. There are 11.1 million unfilled jobs right now, 1.8 times the number of unemployed open jobs right now. The inflation expectations, and you have food rising, you have energy rising, and this, for the mainstream of the economy, hits the pocketbook of the consumer quite hard. So that's something we're watching very, very carefully to see if that could derail. Job market strong, confidence strong, okay? Consumer sentiment, which relates to inflation. That's different from consumer confidence, okay? Confidence is the labor market, sentiment is inflation. And there you had a big fall in the most recent month, in the March consumer sentiment number. That's the Michigan consumer sentiment number, and that basically has been heavily affected by the inflation in the overall consumer price index, and of course, especially food and energy prices. The Fed, is the Fed going to accelerate its monetary tightening? Chair Powell has said, look, we want to get inflation under control. And for many people to feel the Fed can then stop and begin to ease off, you want to get real interest rates up to about 2%. That's the long term. And right now, real interest rates are negative, of course. You have policy interest rate of just barely 0.25 to 0.50%. So there's a lot of road to cover in terms of interest rate increases. And don't forget, starting in May, likely, maybe in May, they will announce the beginning of the contraction of the Fed's $8 trillion plus balance sheet. And that's where they begin to let securities mature, and they don't reinvest the proceeds, and even they could sell some of the securities out of the portfolio. So that is a form of tightening as well. I would be remiss if I did not mention COVID. You have the COVID lockdowns, especially in China, have influenced economic activity, manufacturing activity there, assembly activity there. We have moderation going over into stagflation. Well, it all depends on the consumer. It all depends on the labor market, which, as you know, has been strong. Stagflation, as you know, is when the economy is not growing and inflation is still rising. That's stagflation. And the markets have tended not to like that. Right now, the chances of a recession, I would not say it's a done deal that we have a recession. Let me just remind you, people are talking about the yield curve inversion between the 10-year and the 2-year. Other people look at the 10-year to the 3-month the 90-day Treasury bill rate. So there's a lot of different yield curves that people look at. Some people look at the 30-year versus the 5-year, the 10-year versus the 5-year. So you can find all kinds of yield curves. I tend to look at the 10-year versus the 2-year, which is the classical yield curve spread between the 10-year and the 2-year. Let me just remind you, the 10-year and 2-year, you have had several instances where you have had an inversion, okay? And that's in the document that we're sharing with you. You've had an inversion, but no recession. But you have not ever had a recession without having an inversion of the yield curve. Here's our portfolio positioning. We don't mind having a little bit of cash. Our friend Warren Buffett has been sitting on over $140 billion of cash. And he basically made one acquisition in the quarter of Allegheny Corporation, $11.8 billion purchase. He's been buying back stock. So he's been happy to sit. So are we, happy to hit with a little bit of cash and be very, very opportunistic and nibble at great companies. What am I talking about, great companies? Strong balance sheets, strong pricing power, strong management. The three strongs: strong balance sheet, strong pricing power, strong management. You're going to nibble at these companies on a time-phased basis. This is no time to dump all in there, but you can, if you see a little bit of weakness, then you opportunistically pick off some of this. The Another thing you want to be thinking of is inflation beneficiaries that have this pricing power. I mentioned before, we have had this 1/3 defensives, 1/3 growth, 1/3 value. Now, pharma is in the defensive category. Pharma is down, pharmaceuticals down 2.8% for the year. Financials, if interest rates rise, financials tend to do well. However, when short-term interest rates rise more than long-term interest rates, that puts them under a little bit of pressure. So the financials, with the stock market down 4.7% for the years, financials are down 1.7%. For us, 1.9%. For us to get more bullish on financials, we would need to see that yield curve be positively sloped. Growth, down 9.1% for the year, but value, and value is it's energy stocks, okay? It is financials, down only 1.2%. Emerging markets down 7% for the year to date, 7.6%. We're not inclined to go bottom fishing there just yet. So a little bit of defensives, a little bit of growth, plenty of cash, and opportunistically pick off opportunities and bargains when they present themselves. And with that, we would like to wish everyone Ramadan Kareem. Thank you for listening today.